In January of 2017, an investor sat down with $100,000 and meticulously built what the financial media called a perfectly diversified portfolio. They bought international equities, emerging markets, gold, utilities, and individual tech stocks. It took hours of tracking every week. By May of 2026, that hyper-complex portfolio was cleanly beaten by an investor who did something incredibly boring. They picked just one single fund, closed the laptop, and went for a walk. That single fund turned their $100,000 into roughly $500,000 with zero weekly maintenance. We've been conditioned to believe that building real wealth requires structural complexity. We think that if an investment strategy isn't complicated, it can't possibly be effective. But Warren Buffett famously noted that diversification is often protection against ignorance. It makes very little sense if you actually know what you're doing. So let's run a thought experiment. If you were stripped of all the noise and forced to hold just one single ETF for each decade of your life, what should it be? The answer changes fundamentally as you age, not because the market changes, but because your relationship with time does. Today, we're breaking down a complete age-by-age framework using real historical data up to this year, 2026. We aren't looking for speculative bets or trend-chasing funds. We're looking for the mathematically optimal cornerstone asset for wherever you are right now in your life. The current reality for most people is what I call portfolio drift. In your 20s, you copy a strategy meant for a 50-year-old. In your 40s, you panic switch into cash or high-yield traps because of a bad news cycle. This constant shifting creates a massive hidden tax on your wealth, delayed retirement, compounding left on the table, and a permanent state of financial anxiety. Let's fix that baseline, starting with the decade where you have the most valuable asset in existence, pure time. The 20s, SCHG. When you're in your 20s, your single greatest mathematical advantage is your ability to endure short-term volatility in exchange for massive long-term compounding. You don't need immediate cash flow. You need companies that take their revenue and aggressively plow it back into their own growth. For that reason, if I could only pick one asset for this decade, it would be a US Large Cap Growth ETF. Specifically, the Schwab US Large Cap Growth ETF, ticker SCHG. You might ask, why this over QQQ or VUG? QQQ tracks the NASDAQ 100, which restricts it to just 100 non-financial companies. It's highly concentrated. SCHG, on the other hand, tracks the Dow Jones US Large Cap Growth Total Stock Market Index. It holds 196 positions across all sectors, including financials. A bit broader, a bit more balanced, and a lot more room to breathe during sector rotations. When you buy this fund, you're getting immediate exposure to the absolute titans of the modern economy. And the cost to own it? An expense ratio of just 0.04%. That's $4 per year for every $10,000 invested.
Notice something. The trailing dividend yield is an exceptionally low 0.37%. To an untrained investor, that looks like a flaw. To an intelligent investor, that's a feature. You do not want these companies writing you a check in your 20s. You want them using that cash to build data centers, acquire competitors, and scale operations. Income can come later. Right now, you want growth. Look at the data. From January 2017 through May of 2026, SCHG averaged roughly 19% per year in total return. That means $100,000 left alone became approximately $500,000 simply by holding and doing nothing else. Yes, it will experience sharp drawdowns. There will be years it drops 20, 25, even 30%. That's not a bug in the strategy, it's the price of admission for long-term outperformance. If you're 24 and can leave the money alone, volatility is just noise. The mistake most young investors make is reacting to that noise. The 30s, VOO. As you move into your 30s, life gets more serious. Mortgages, families, career pivots. The stakes of a 30% drawdown feel different at 34 than they did at 24, and your portfolio strategy should reflect that. The single choice for your 30s is the bedrock of global finance, an S&P 500 index fund, specifically Vanguard's S&P 500 ETF, ticker VOO. VOO gives you immediate ownership of 500 of the largest, most stable U.S. corporations. There are alternatives like SPY, but SPY is optimized for active day traders and carries a higher fee. VOO gives you the exact same exposure for just 0.03%, $3 a year per $10,000 invested. Look at how the risk profile shifts here. In SCHG, your top 10 holdings made up more than half the fund. In VOO, because it spans 500 companies, concentration risk is diluted. Tech exposure drops to around 33%, while financials step up as the second largest sector. You keep the same top names, Nvidia, Apple, Microsoft, but now they're a smaller slice of a much larger pie. Holding VOO over the same multi-year period would have turned $100,000 into roughly $374,000, delivering a highly respectable 15% annualized return, alongside a quiet 1.06% dividend yield you can reinvest without thinking about it. And here's a number worth pausing on. VOO is now the largest ETF in the world by assets under management, sitting at over $1.6 trillion. There's a reason that number is that large. It's the default long-term holding for a lot of serious investors, not because it's exciting, but because it works. The 40s, VTI. By the time you reach your 40s, you likely have a clearer picture of your peak earning potential. Your portfolio size is no longer trivial. At this stage, a subtle but vital shift needs to happen. You want to capture the growth of the entire economy, not just the mega caps dominating the headlines. The single choice for your 40s is the Vanguard Total Stock Market ETF, ticker VTI. Instead of limiting yourself to the 500 largest companies, VTI broadens your horizon to over 3,520 holdings, large cap, mid cap, and small cap, every major sector. It's essentially the entire US economy in a single ticker. Historically, VTI has trailed VOO by just a fraction, averaging around 14.6% per year, turning that same $100,000 into roughly $356,000. The same dividend yield, the same 0.03% expense ratio. So why take that slight haircut on returns? Because you're buying insurance against a structural regime shift. If mid-cap and small-cap value stocks begin to outperform mega-cap tech over the next decade, and historically cycles like that do happen, VTI captures that rotation automatically. You're not entirely dependent on a handful of tech giants continuing to dominate. That's not a small thing when your portfolio has grown large enough to make concentration risk a real threat. The 50s, VIG. Now we enter the critical zone. Your 50s are when the structural psychology of investing changes entirely. Here's the hidden trap most people fall into. They realize retirement is only a decade away, panic about market crashes, and immediately dump their growth assets into high-yield dividend funds or long-term bonds. This is a massive mistake. In your 50s, your money still needs to grow because it has to last you another 30 to 40 years. You don't want high dividend yield yet, you want dividend appreciation. My single choice for this decade is the Vanguard Dividend Appreciation ETF, ticker VIG. VIG doesn't chase the highest paying stocks, it looks for the highest quality companies that have a proven track record of growing their dividend year after year, meaning they've been financially healthy enough to keep raising payouts through multiple downturns. The fund holds around 334 positions, led by blue chips like Broadcom, Apple, and Microsoft. Expense ratio, just 0.06%. Here's the number that actually matters at this stage of life. While VIG delivered a slightly lower annualized return, averaging around 12.7% per year, turning that same $100,000 into roughly $319,000, the downside protection was exceptional. During the worst macroeconomic pullbacks in recent history, VOO dropped roughly 18%, VIG dropped only 9%. That might not sound dramatic until you're 54 and watching a significant chunk of your retirement shrink in 12 months. The emotional cost of that is real, and emotional decisions at 54 can permanently derail a retirement plan. VIG is how you stay in equities with genuine upside while cutting the volatility you'll actually feel.
The 60s, SCHD. When you hit your 60s, the paradigm shifts from accumulation to distribution. The primary objective is no longer maximizing the size of the pile. It's ensuring the pile safely and predictably generates cash flow, so you never have to sell shares during a market downturn. The gold standard for the stage is Schwab's US Dividend Equity ETF, ticker SCHD. SCHD tracks the Dow Jones U.S. Dividend 100 Index, 100 companies selected specifically for the quality and sustainability of their payouts. We're talking Coca-Cola, Texas Instruments, Chevron, companies that have raised their dividends for at least 10 consecutive years and passed strict screens for cash flow and return on equity. With a dividend yield of around 3.24%, the real-world application changes entirely. A $1 million portfolio in SCHD generates roughly $32,400 per year in pure income, paid quarterly, completely independent of day-to-day stock price movement. Since its inception in 2011, SCHD has delivered around a 13% annualized total return. But the number that actually matters in retirement is this. SCHD's worst single year was down only about 5.5% compared to the S&P 500's 18% in the same period. In retirement, a 5.5% drawdown is survivable. An 18% drawdown, especially early in retirement, can permanently compress how long your money lasts. That asymmetry matters far more than raw return numbers. The 70s, JEPI. According to the CDC, the average life expectancy in the US is 79 years old, but if you're 65 and in reasonable health today, there's roughly a 25% chance you live past 90. That's not a statistic most people take seriously enough when they're planning. Planning for your 70s isn't just about income, it's about income that doesn't run out. For this stage, my pick is JEPI, JP Morgan's Equity Premium Income ETF. JEPI is a fundamentally different animal than everything else we've discussed today. It's an actively managed fund that holds defensive large-cap US stocks and overlays a covered call option strategy to generate income. That's also why the expense ratio is higher, at 0.35%, and why it's not very tax efficient inside a standard taxable brokerage account. Ideally, you hold this in a Roth IRA or traditional IRA to avoid that friction. Over the past year, JEPI has paid out a trailing dividend yield of approximately 8.44%, distributed as consistent monthly income. On the median retirement savings of around $432,000, which is roughly where the average American lands in their 70s according to Empower, that generates about $36,400 per year, or right around $3,000 per month. Now, a yield that high deserves scrutiny. A large portion of JEPI's income comes from options premiums, not traditional dividends. That's what makes it tax inefficient outside a retirement account. The income also varies month to month, and in strong bull markets where stocks just go straight up, JEPI tends to lag because the option strategy caps some of that upside. Morningstar notes the fund's yield has ranged between 8 and 12% since inception, so it's not always this high, and it can move around. That said, the downside protection is genuinely impressive. Since inception in May 2020, JEPI's worst year was down only about 3% compared to the S&P 500's 18% in that same 2022 downturn. Over the last 5 years, it has averaged about 7.7% per year in total return. For someone in their 70s who may also have Social Security, a pension, or other income sources, JEPI isn't supposed to be the whole picture, but as a core income-generating holding inside an IRA for consistent, predictable monthly cash flow with low downside risk, it's one of the most compelling options in the market for this stage of life.